My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll do it, my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. At last, the economy slowed enough that the Fed can take its foot off the brakes and step on the gas. That's why we're starting our game plan in the middle of next week, when the Federal Reserve renders its verdict, 25 or 50 basis points. We don't typically have a lot of drama in this business, but this one counts as a nail-biter, because we really don't know how big the rate cut will be. We just know they're going to cut. Today's rally, with the Dow gaining 297 points, S&P advancing 0.54%, NASDAQ climbing 0.65%, capping off the best week of the year for both the latter two, the S&P and the NASDAQ, suggests the Fed might actually go 50. That's a double rate cut. I know this because the stocks most sensitive to interest rates, the housing and housing-related names, went off today, to use a little NFL fantasy football lingo. They soared, presumably in anticipation of something huge from J. Powell and company.
All aboard!
I still find myself betting on a quarter-point cut, though. See, it's not that we don't need a half-point cut, as the economy is slowing pretty quickly, especially for the lower-income cohort. But I've always believed that the Fed should be measured when it cuts rates. At this stage of the business cycle, the biggest risk is that inflation might flare up again if you cut too much. And a 50 basis point cut all at once makes that a lot more likely. Plus, a double rate cut signals that something may be very wrong with the economy, something we don't know about, something lurking. So going 50 could inspire panic. And there's simply no reason for the Fed to take that chance when it can simply hit us with a series of thoughtful 25 basis point cuts that neither reignite inflation nor cause panic. Now, if the housing rally continues at this pace, these stocks run the risk of being too hot to handle for a mere 25 basis point cut. And we'll get a sell-off in response in those stocks. Keep in mind, housing caught fire because a reading from CME Group's FedWatch tool, which tracks interest rate expectations based on the Fed funds futures market, indicates that traders are now pricing in a much higher probability of a double rate cut, currently 45%. That's much higher than it was a week ago. These people will indeed be disappointed if the Fed decides to be more measured. These gunner traders could be your enemy come Wednesday at 2 p.m. as they dump what they bought incorrectly. And that is what happens. That's what traders do. They let the stocks go. Now, there are other important events next week. We'll be broadcasting, by the way, from San Francisco all week, making our annual pilgrimage for Salesforce's Dreamforce conference. It's going to be a couple of big days. By the way, I'll be at Dreamforce on Tuesday. But let's not get ahead of ourselves with the game plan. On Monday, Regeneron's presenting, that's a biotech company, and holding an analyst meeting at the European Society for Medical Oncology's annual meeting, where they'll showcase their oncology portfolio, which is bountiful, including formulas to treat advanced melanoma and non-small cell lung cancer. These are important drugs that have helped diversify Regeneron's business, but I'm still focused on the company's obesity drug candidate. When I was at a J.P. Morgan Healthcare Conference in San Francisco earlier this year, I pulled up with Regeneron CEO Len Schleifer. He's an old friend of the show who was one of our first guests. He was confident that his company might have a weight loss drug that only attacks fat, not muscle. That's huge, as people who take GLP-1s experience muscle atrophy unless they work out pretty consistently. I think this drug would be an instant success if it can get through the clinical trials. Right now, it's too early in the process to take anything as gospel. Tuesday, we get retail sales, perhaps the last data point before the Fed renders its decision. Now, normally I wouldn't sweat the program here, but the number represents the best gauge of consumer spending, and two-thirds of our economy runs on consumer spending. I think, actually, it's going to be a weak number. When you're at the beginning of a rate cycle, you've got a rate cut cycle, you have to indulge in a leap of faith. You have to just take it as gospel that 25 or 50 is going to ignite housing-related construction no matter what. And that's how it normally plays out. So you might be interested in a company, we had them on actually, called Ferguson, which distributes all sorts of products that go into new construction. Think plumbing, appliances, heating, ventilation, air conditioning systems, HVAC. Ferguson's levered directly to interest rates, which is what you want when the Fed's about to start easing. Now, we don't just get the Fed's decision on Wednesday. We also get earnings from General Mills, which is on a mission to upgrade its portfolio. Mills just offloaded its North American yogurt division for $2.1 billion. It represents, what's it got, really? When you look at the prestige, it's got snacks and pet food franchises. They're very, very strong. And I think you're getting a bargain with the stock here. Unfortunately, Wall Street tends to abandon the packaged food place when the Fed starts cutting. They grow too slowly for traders. Thursday, well, there's a cornucopia of earnings, starting with Darden Restaurants, which tend to swing with the same-store sales of its largest division, which is Olive Garden. It could surprise, but you know what? After speaking to the CEOs of Sweet Green and Cava in the last couple of weeks, I vastly prefer those two fast casual chains. Even up here, they're worth buying on any pullback. Cracker Barrel also reports, and talk about a work in progress. The redoubtable and implacable CEO, Julie Masino, is attempting to turn this old battleship around, and it won't be easy. You have to keep the current clientele pleased while luring in new people. Messino's approaching this term methodically. I really like that. I think she can get it right. I just don't know if she can get it right this fast. Again, I'm calling this a work in progress. After the close, we get results from FedEx and Lennar, two incredibly important companies for the economy. FedEx is undergoing a gigantic turnaround led by CEO Raj Subramanian, who's cutting costs while growing revenues. Oh, that's a near impossible task. But he's pulling it off. And Lennar, classic home builder. Hearing from them a day after the Fed meeting could be very enlightening. I think Lennar will tell a terrific story. And if we get a 50 basis point cut, its stock might be a terrific place to be. When I look at next week, I can only conclude that we're finally at the moment we've all been waiting for. So let me give you the bottom line. If we sell off on a 25 basis point rate cut, remember this phenomenal week, because there'll be plenty more like it as the easing process continues and progresses. Oh, there will be bear phases too, but as long as you recall that we're no longer fighting the Fed, those phases can be bought, not sold.
Bye. All aboard!
Matt in Massachusetts. Matt.
Hey, Jim. Booyah.
Booyah, Matt. What's happening?
Well, I want you to know that me and my 8-year-old daughter watch your show every night, and I've been watching it since you came on over 20 years ago. So
does she like NVIDIA here? What is she doing? Is she swapping out NVIDIA and going for more Amazon?
She still has some NVIDIA, and she loves AT&T, actually.
Really? She's a contrary player. Well, you know what? The kid's got horse sense because the stock's going up. Now, it's going up without me, but you can tell your 8-year-old daughter that she is spot on. I saw the interview that David Faber did with the CEO of AT&T. She's right. I congratulate her for a really good call. Now, what's your stock right now?
So I'm long on Schlumberger in my retirement, but I'm getting killed lately, and I'm wondering if it's to hold on to it or...
Matt, this is such a tough one. SLB is an amazing company. I actually interviewed with SLB in 1983 for a job, and they told me to get the hell out. I didn't know anything. And I took that as gospel. I do think that SLB is a very inexpensive stock, and I would not sell it down here. Let's go to Stephen in New York. Stephen.
Jimmy Chill. Hope you're doing well on this Friday evening.
Getting ready for a big wedding this weekend. Can't wait.
Awesome. My question's about TPL. The stock's up about 50% year to date, approaching its 2022 high. TPL is primarily an oil and gas royalty company, but the water business is growing. It's now about a quarter of the company's net income. Do you think they should keep that sleeve of their business or maybe spin it out into its own water utility?
Why do I love this show after all the years? Because here's Stephen telling me about a stock, TPL, that I don't know enough about, and this water business. And I'm going to sit down with our chief scientist and research director, Ben Stoto, and get to the bottom of whether TPL is worth buying. I had no idea about the water business. Thank you very much, Stephen, for teaching me. I get taught every day, and I like being taught. After a rate cut, as long as you remember that we're no longer fighting the Fed, bear phases can be buying opportunities, not selling ones. Well, man, tonight, has former Ulta CEO Mary Dillon put her best foot forward during her tenure so far at Foot Locker? I sat down and tried a pair of shoes on with the top brass herself at the company's new Herald Square store to find out that Adobe stock hasn't been doing so hot. But is the company illustrating that it could stage a turnaround? I'm going to give you my take. And we held our monthly investing club meeting yesterday and had so many questions from club members and not enough time to take them. So what we're going to do? I'm digging into the rest of them tonight. So stay with Cramer.
Don't Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.